We're told constantly that diversification is the bedrock of smart investing. Don't put all your eggs in one basket, right?
Right. It's fundamental.
It's how you manage risk. But what if you could have too much of a good thing? What if, at a certain point, adding more investments actually starts hurting your portfolio's potential?
Yeah, weakening that crucial balance between risk and return.
There's a term for this, diversification. It's catchy, maybe even a little funny.
It is, but it's serious.
It highlights a genuinely fascinating and challenging dilemma for investors, where precisely is that point where diversification stops helping and starts harming.
That's the million-dollar question.
And what happens when something truly unpredictable and massive, like a global pandemic, completely shakes up the market? Does that delicate balance point shift?
A huge question, especially now.
We've been sent a fascinating stack of source material by one of you, our sharp-eyed listeners, diving deep into this exact question for U.S. investors using recent data.
Really interesting stuff.
That's our mission today. To unpack this idea of diversification, understand what the cutting-edge research based on real-world performance says about finding that optimal balance, and figure out what these insights truly mean for how we think about building a portfolio, whether you're managing it yourself or working with a professional.
That's right. It's a concept that seems simple on the surface, just keep adding things.
Right.
Spread it out.
Seems logical.
But the reality, and what the research underscores, is far more nuanced. While the core principle of spreading risk is foundational, blindly accumulating assets can easily become counterproductive.
Right.
We're going to peel back the layers on how this happens, look at the very real costs associated with it,
Okay.
and then dive into what recent data from U.S. markets, specifically from professional mutual funds, tells us about where that optimal point might lie.
Ah, the mutual fund angle. Interesting.
Yeah, and how major disruptions, like the unprecedented conditions during the COVID-19 pandemic, actually alter the picture.
Okay, let's start at the beginning then. Let's unpack this foundational idea. We all hear diversification, diversification, diversification.
Sounds like.
It's the absolute first lesson you learn in investing, the classic, don't put all your eggs in one basket. And it's not just folksy wisdom, it's rooted in incredibly solid financial theory, isn't it?
Absolutely. The theoretical underpinning comes directly from modern portfolio theory, or MPT.
MPT, right.
This was groundbreaking work pioneered by Harry Markowitz back in the 1950s. His insight fundamentally reshaped how investors, especially large institutions, think about building portfolios.
A huge impact.
The core principle is brilliant in its simplicity. By combining assets that don't all move in perfect unison, that have varying correlations, as the theory puts it.
Varying correlations. So like when one asset is going up, maybe another isn't or is even going down. So they kind of smooth each other out.
Exactly. That's the gist of it. You combine these assets and you can construct a portfolio that has a lower level of overall risk than the individual assets within it, without necessarily sacrificing the potential for return.
Lower risk, same potential return. Sounds like the holy grail.
Well, it's about optimizing the trade-off. Think of it like this. If you own stock in just one company, say a tech startup, you're exposed to all the specific risks of that company. Maybe their new product fails, their CEO leaves, they get sued. That's called idiosyncratic risk.
The risk unique to that one thing.
Precisely. MPT shows you can essentially diversify away a significant portion of that specific individual risk by holding a basket of different assets, stocks in different companies, maybe different sectors, bonds, maybe real estate.
Trapping the bets.
Right. If one company has a bad day or year, the others in your basket help cushion the blow. It's precisely the eggs in one basket idea applied mathematically. You reduce the risk specific to any single asset.
Okay, so MPT gives us the crucial positive side. The benefit of spreading risk to reduce the impact of individual failures or events. That's the diversification part we all know and love.
The good stuff.
Now, introduce us to the villain of this story, diversification.
Right. Diworsification, the term popularized, I believe, by the legendary investor Peter Lynch.
Peter Lynch. Makes sense.
It's a clever wordplay that perfectly captures the negative phenomena we're talking about. Diversification is what happens when you take the principle of diversification too far, or maybe apply it poorly.
Okay, how so?
It's the point where adding more investments to your portfolio actually starts to detract from its overall quality. It weakens that critical risk-return trade-off that MPT aims to optimize.
So you go past the peak benefit.
Exactly. You're diversifying past the point of maximum benefit and into territory where the downsides of adding more assets like complexity, cost, maybe just average performance, outweigh the marginal reduction in idiosyncratic risk you get from adding one more thing.
So it's not just about the number of things you add, but how and why you're adding them and what they are. How do investors typically stumble into this diversification trap, according to the sources?
The sources highlight a few common culprits, especially for individual investors who might not have, a super rigorous portfolio construction process.
Right, like most of us.
One is impulse investing. This is buying based on hot tips, news headlines, maybe something you saw on social media.
FOMO investing.
Pretty much. Buying based on buzz or just a gut feeling without really considering how that new investment fits into your existing portfolio, what its risk profile is, or crucially, its correlation with your other holdings. You see something exciting and just add it.
Yeah, I can see that happening easily. What else?
Another common way is style drift. This happens when you start with a relatively clear investment strategy. Maybe you decided to focus on dividend-paying stocks or growth companies or value stocks in a particular sector.
You have a plan.
You had a plan. But over time, you add other types of investments that don't really align with that initial strategy. You might add some international stocks when you plan to be purely domestic, or small cap when you were focused on large cap.
Or crypto, or commodities.
Exactly. Maybe even completely different asset classes like commodities without a specific strategic reason. Your portfolio starts to lose its focus and becomes, well, kind of a jumble.
It's like you started building a focused collection and ended up with a random assortment of whatever you happened to pick up along the way.
Precisely. And the third factor the sources mention is generally favoring a particular sector, or what's often called sector overweighting.
This one seems subtle but important.
Very. You might think you're diversified because you own stocks in 50 different companies. Sounds great, right?
Yeah, 50 is a lot.
But if all 50 of those companies are in the technology sector or energy or financials, you are still highly exposed to the risks specific to that sector.
So you're diversified across companies, but not across industries.
Exactly. If there's a downturn or regulatory change that hits the entire tech industry, owning 50 tech stocks won't protect you much more than owning, say, 5 well-chosen ones, or maybe even just a tech sector ETF. You've diversified away company-specific risk, perhaps, but you haven't diversified away sector-specific risk or broader market risk nearly as effectively.
That's a critical distinction.
Right.
You've got quantity, but not necessarily the right kind of diversity. Now, all of this talk about optimal allocation, varying correlations, risk-return trade-offs, it sounds incredibly complex.
It can be.
Is that part of why diversification is so easy to fall into for the average person?
It absolutely is. The full implementation of modern portfolio theory, finding that truly optimal allocation that sits on the theoretical efficient frontier.
The efficient frontier, okay.
That curve representing the best possible return for every level of risk that requires sophisticated tools, massive amounts of data on asset correlations, volatility, expected returns.
Stuff most people don't have access to.
Right. And the computational power to process it all. This kind of capability is standard for large institutional investors, the pension funds, endowments, massive mutual funds. They live and breathe this stuff.
But not for you and me trying to manage our retirement accounts.
Exactly. For the everyday individual investor, or even a typical financial advisor serving individuals, that level of detailed security-by-security MPT mapping technology needed to pinpoint their specific optimal allocation is, as the sources put it, nearly inexistent in practical terms.
Nearly inexistent.
Wow, they often lack the resources, the granular data, the time needed to perform that kind of rigorous continuous analysis. This makes intuitive diversification just adding stuff much more common than optimal diversification, leaving the door wide open for diversification to creep in.
Okay, so it's easy to slip into. If an investor does fall into this trap, if their portfolio becomes diversified, what are the actual consequences? What hits their bottom line?
Well, the most direct and significant impact, as the sources highlight, is the dilution of potential returns.
Dilution? How does that work exactly?
When you add more and more investments, especially those that may not have the same growth potential or yield as your strongest performers, you effectively water down the overall performance of the portfolio.
Right.
Imagine you have a few investments doing exceptionally well, real stars. As you add dozens or even hundreds more holdings, each of those star performers becomes a smaller and smaller percentage of the total portfolio.
Their impact shrinks.
Exactly. The strong gains have less impact on the average performance. Meanwhile, mediocre or underperforming holdings, simply by their sheer number, can easily offset the gains of your winners,
pulling the average down,
leading to a dull, middle-of-the-road, or even poor overall result. It's like adding too many average players to a basketball team with a couple of superstars.
Yeah, I like that analogy.
The team's overall scoring average or win rate might go down because the average players are dragging down the performance. You might feel safer with more players on the roster, but you've diluted your potential to win big.
So you're not necessarily reducing risk optimally anyway, but you're definitely averaging down your potential upside. What are the other tangible costs? Seems like there'd be more.
Oh, definitely. There's a significant increase in complexity and management difficulty. That's a big one.
Just keeping track of it all.
Exactly. As your number of holdings explodes, whether it's individual stocks, bonds, or even multiple funds, keeping track of everything becomes a real burden. Monitoring the performance of each piece, staying informed about the underlying companies or assets.
Knowing why you own each thing.
Right. Understanding how they contribute to your overall strategy and making timely decisions about buying, selling, or rebalancing becomes incredibly time-consuming and challenging.
I can imagine. It's hard enough with a few holdings.
It's hard to maintain a clear strategic overview of your portfolio when you're trying to juggle too many individual pieces. You can easily get lost in the weeds, focusing on minor movements in one stock while missing larger trends or imbalances in your overall strategy.
That sounds like a lot of work just to potentially get worse results. And I'd assume more holdings mean more money spent somehow.
Absolutely. Higher costs are a major tangible risk of diversification. Every time you buy or sell an investment, you typically incur transaction costs, brokerage fees, commissions, bid-ask spreads.
The friction costs.
Exactly. The more frequently you trade and the more holdings you have to manage and potentially adjust, the more these transaction costs add up. These costs directly eat into the net returns of your portfolio. It's money straight out of your pocket.
And if you're using funds?
Furthermore, if you're diversifying by buying lots of different mutual funds or ETFs, you're paying the expense ratio for each of those funds.
Yeah, the ERs.
Holding a dozen funds, each with an expense ratio of, say, 0.2% or 0.5% or even higher, adds up to a significant drag on your returns compared to holding just a few carefully selected low-cost options. These accumulated costs can significantly reduce the money you actually keep from your investment gains. It's death by 1,000 cuts.
Okay, so we know diversification is good. Diversification is a costly trap. This brings us to the burning question. Is there a sweet spot? Is there an optimal number of investments? The research our listener shared seems to tackle this head-on using recent data.
Yes, this is where the sources provide specific, data-driven insights. The idea of an optimal number of holdings has been explored in financial literature for a long time.
It's not a new question, then.
Not at all. Early studies used theoretical models or simulations, and the results varied quite a bit. The core concept is that the benefits of adding investments, primarily reducing that idiosyncratic risk we talked about, eventually start to plateau.
Diminishing returns.
Exactly. At some point, the marginal benefit of adding one more stock becomes tiny, while the costs and complexity continue to increase. Finding that precise point where the benefits are maximized relative to the downsides is the goal.
And this particular research zeroes in on U.S. markets using a very specific data set, right? What were they looking at?
Exactly. This key study focuses on U.S. equity mutual funds, examining their performance and holdings from the third quarter of 2016 through the second quarter of 2023.
So pretty recent data. Why mutual funds?
It's a highly relevant data set for several reasons. Firstly, domestic equity funds represent the largest share of the U.S. mutual fund market, around 44% in 2022. So it's where a lot of money is.
Okay.
Secondly, the U.S. stock market is globally dominant in terms of total value and investor focus.
Makes sense.
And thirdly, looking at mutual funds gives us a window into how professional managers approach this challenge of diversification. These are people paid to do this.
So we're getting insights from managers handling billions of dollars. How did they analyze this? What relationship were they looking for exactly?
The study's methodology is quite rigorous. They examined the relationship between a fund's risk-adjusted performance measured using the Sharpe ratio.
Sharpe ratio. Okay.
Yeah.
Return versus risk.
Right. It tells you how much return you're getting for the amount of risk you're taking, a standard measure. They looked at the relationship between that Sharpe ratio and the number of stocks that fund held.
Simple enough on the surface.
But to ensure they were isolating this specific relationship, they used advanced statistical techniques like a fixed effects model. This helps control for other factors that might influence a fund's performance.
Like what?
like the overall market movements during that period, or specific, unchanging characteristics of each fund, things like its investment style or maybe even the skill of the management team. It's about trying to see how the number of holdings, holding other things constant, impacts performance.
Got it. Trying to isolate that one variable. And what did their analysis reveal? Was there a clear pattern between the number of stocks and the Sharpe ratio?
Yes, a very clear pattern. They found a statistically significant quadratic relationship between the Sharpe ratio and the number of stocks.
Quadratic. Okay, help me visualize that. What does that mean?
It's a critical finding that basically plots out the concept of diversification. Imagine a graph. As you move from left to right, increasing the number of stocks held by a fund, the Sharpe ratio initially increases. It goes up.
That's the diversification benefit kicking in.
Exactly. Adding stocks effectively reduces idiosyncratic risk, improving risk-adjusted return. But after reaching a peak, the curve starts to decline. It heads back down.
So it goes up, hits a high point, and then starts falling.
Precisely. That downward slope represents the diversification effect. Adding even more stocks beyond that peak begins to reduce the risk-adjusted return. Likely due to those factors we discussed. Diluted returns from the stars, increased complexity, higher costs starting to outweigh the minimal diversification benefit gained from adding yet another security.
So there's a clear peak on that curve, an optimal number where the risk-adjusted return was highest, according to their model. What number did this study calculate as that optimal point for U.S. equity mutual funds during this sample period?
Okay, so based on their comprehensive analysis across this 2016-2023 timeframe, the study calculated the overall optimal number of stocks for U.S. equity mutual funds to be approximately 265 to 285 stocks.
Wow. 265 to 285 individual stocks. That sounds like a very specific and, frankly, quite large number of holdings for a single portfolio.
It is quite specific, and yes, it's a substantial number. That range represents the peak of that quadratic relationship. They identify the point where, on average, these funds achieve the best balance of return for the risk taken, according to the Sharpe ratio metric during that period.
So 265 to 205, how does that compare to what typical U.S. equity mutual funds actually hold? Did they look at that?
They did, and that's a crucial point for context. The study also looked at the descriptive statistics of the funds in their sample. The average number of stocks held by these funds was significantly lower than the calculated optimal.
Lower by how much?
It came in at around 102 stocks on average.
Only 102, compared to an optimal of like 275.
Exactly. The range of holdings in their sample was wide, mind you, from a minimum of just 13 stocks in some very focused funds, up to a maximum of 621 stocks.
Huge range.
But the average was 102. What this tells us is that, based on this research, the average U.S. equity mutual fund during this period was operating on the left side of that optimal peak.
So holding fewer stocks than what the study suggests would maximize their risk-adjusted return according to the Sharpe ratio analysis.
That's what the data implies for this period, yes.
So most funds aren't necessarily diversified according to the study's calculated optimal number. They might actually be under-diversified relative to maximizing risk-adjusted returns. That's kind of surprising.
It is interesting, isn't it? It suggests that for many funds, adding more carefully selected holdings, moving closer to that 265, 285 range, could potentially have improved their risk-adjusted performance during that time.
Did they look at the really concentrated funds too, the ones with fewer holdings?
They did. The study also looked at the funds broken down into quintiles based on the number of holdings. Even the funds in the lowest quintile, the 20% of funds holding the fewest stocks, still averaged about 40 holdings.
So even the least diversified were holding 40 stocks on average.
Right. So even the least diversified funds in their filtered group were still holding a substantial number of stocks, meaning they were far from holding just a handful. The study also briefly notes that when they looked at performance using a different lens, using factor alphas.
Factor alpha is like performance unexplained by market movements or size.
Yeah, basically assessing returns unexplained by standard risk factors like market beta, size, value to the CAPM, Fama French, Carhart models. When they use those measures, the funds in the lowest diversification quintile, around 40 stocks, tended to underperform the more diversified ones, the highest quintile.
So holding too few wasn't great either.
It seems that way. It further supports the idea that simply holding a small number of stocks, even 40, might still leave significant room for improvement through increased diversification. It reinforces that some diversification is definitely good.
It seems clear that some level of diversification is essential, and perhaps more than the average fund is currently implementing could be beneficial based on this data. Now, you mentioned earlier that optimal numbers can shift depending on the data and time period. How does this 265 to 85 figure compare to previous studies? Did they mention that?
They did, and that's an important caveat that the study itself points out. They reference an earlier paper by Shockey and Smith, published back in 2005, which used data from 1992 to 2000.
Okay, an older period. What did they find?
They found a considerably higher optimal number of stocks, specifically 481.
481, wow, that's way higher than 285.
It is. This comparison highlights a few things. Firstly, the specific numerical optimal is not a static universal constant. It can change over time as market dynamics, correlations between assets, and even the characteristics of the companies within the market evolve.
Markets change, the optimal mix changes.
Seems plausible.
Yeah.
Secondly, differences in methodology, the exact time period covered, and the specific data set used can all influence the result. So, while this new study provides a figure for a recent period, 265 to 85, it's a snapshot, not necessarily a timeless universal truth carved in stone.
Good context. Okay, so the study gives us this optimal range, 265, 285 stocks, based on data covering a relatively stable period overall, but with a huge disruption right smack in the middle.
Exactly.
How do major market events, especially crises, factor into this picture? Does chaos change the rules of diversification?
That's a critical question. Market conditions, particularly periods of high stress, volatility, or outright crisis, are known to fundamentally alter the dynamics between different assets.
Things get weird.
They really can. Correlations can change dramatically. Sometimes assets that usually move independently suddenly start moving together in lockstep, which kills diversification benefits.
When everything goes down together.
Exactly. Or sometimes correlations break down in unexpected ways. This directly impacts the effectiveness of diversification. Previous research has explored how institutional investors adjust their portfolios during crises.
What did they find, generally?
Well, the findings were a bit mixed. Some studies found managers might increase holdings to try and gain more diversification benefit in uncertain times, while others suggested they might actually become less diversified.
Why less?
Maybe focusing only on assets they know intimately or where they perceive they have an informational edge, sort of retreating to core competencies during stress.
Interesting. So this study had the unique opportunity to analyze the impact of a truly unprecedented recent crisis, the COVID-19 pandemic. What made the COVID period particularly interesting for this kind of analysis?
Well, the COVID-19 crisis wasn't just a typical economic recession or financial crash, was it?
Definitely not.
It was primarily triggered by an external, non-financial shock, a global health crisis that had these massive cascading effects on economies and markets worldwide.
Everything just stopped.
Right. This led to an initial rapid and severe market decline, followed by a period of unusually high volatility and uncertainty that persisted for quite some time. This unique blend of rapid shock and prolonged volatility provides a fascinating natural experiment to examine how the optimal diversification strategy might shift compared to calmer periods.
Okay, so they looked at the COVID period specifically within their overall 2016-2023 dataset. What did they find about the optimal number of stocks during that tumultuous time? Was it lower, higher, the same?
This is where the findings are particularly insightful and, for some, might seem counterintuitive. The study explicitly compared the optimal number of stocks during the identified COVID-19 period within their sample to the non-COVID-19 periods. They found that the optimal number of stocks for U.S. equity mutual funds was actually higher during the COVID-19 crisis period.
Higher. Wow. When things are volatile and uncertain, you might instinctively think managers would pull back, simplify, focus on a core set of assets they know best, like you just mentioned some studies found.
Right. That would be an intuitive reaction.
But the data suggests more diversification was needed for optimal risk-adjusted returns during COVID. What were the actual numbers?
That's right. The numbers showed a distinct shift upwards. Their analysis calculated the optimal number of stocks during the COVID-19 period to be approximately 293 stocks.
293. And what was it during the non-COVID periods in their sample?
During the non-COVID-19 periods, it was calculated at approximately 278 stocks.
So 278 versus 293, that's a difference of about 15 stocks. Not huge, but definitely noticeable.
Noticeable and statistically significant in their model, yes. It suggests that more holdings were needed to achieve the best risk-adjusted outcome during the pandemic chaos compared to the surrounding calmer periods.
That's a significant finding. What are the potential explanations or implications for why more diversification was optimal during COVID-19? Why would you need more stocks when things are crazy?
The study explores a few potential reasons. One key implication is that the increased volatility and the unique nature of the COVID-19 shock might have meant that asset correlations changed in a way that required holding a broader array of stocks to achieve the same level of effective diversification and risk reduction compared to calmer times.
So things that normally didn't move together suddenly started moving together because of the pandemic.
That's one strong possibility. Perhaps assets that normally weren't highly correlated started moving together in response to the pandemic shock. Maybe everything related to travel went down, everything related to staying home went up, regardless of sector sometimes. This means you needed to add more different kinds of companies or sectors, cast a wider net, to truly dampen overall portfolio volatility and smooth out returns.
The sheer unpredictability demanded a wider approach.
Possibly. The sheer unpredictability and widespread impact of the pandemic might have demanded that wider net. This contrasts with some earlier crisis studies where managers might have become more focused, perhaps because those crises were more financial in origin. The external, universal nature of the COVID shock, affecting potentially many assets similarly, regardless of their fundamental financial health initially, might have driven this need for broader diversification, pushing that optimal point further to the right on our quadratic curve graph.
So the picture isn't static at all. Market crises, especially unique ones like COVID-19, don't just stress test your portfolio. They can actually change the very dynamics of what constitutes optimal diversification at that moment.
Precisely. The environment dictates the strategy, or at least influences the optimal parameters of that strategy. It really underscores that portfolio management, even at the professional level, is a dynamic challenge, not a one-time static exercise you set and forget.
All right, this is fascinating stuff. We've defined the terms, explored the costs of getting it wrong, and looked at this research giving us a data-driven range for optimal diversification in U.S. equity mutual funds, and how a crisis like COVID-19 shifts that number. So let's bring this home. What does this all mean for the listener? How can someone navigating the investment landscape, whether they manage their own money or work with someone, avoid diversification and actually aim for something closer to optimal diversification?
Right, that's the crucial so what. The sources outline several practical approaches investors can use, keeping in mind that most individuals don't have that institutional-grade MPT software we talked about.
Okay, what are the options?
Well, one leading avenue is working with financial advisors. Many advisors use sophisticated platforms and technology these days designed to help with overall asset allocation.
The big picture, stocks, bonds, etc.
Exactly. Deciding how much of your portfolio should be in stocks, bonds, real estate, international, and so on, based on your goals and risk tolerance. They can also use tools to help guide on the weighting of different securities within those allocations to build a more diversified portfolio.
And they help keep it on track.
Yes, advisors also provide crucial rebalancing services, which is key because over time, a portfolio can drift away from its target allocation as different assets perform differently. Regular rebalancing helps bring it back in line with the strategy.
So leveraging professional expertise and their access to better tools. What about more technology-driven options directly available to investors? Things like robos.
Yep, robo-advisors and wrap accounts are another increasingly popular solution mentioned. These platforms use algorithms and technology, often built on MPT principles, to recommend and manage diversified portfolios of funds, typically low-cost ETFs.
You fill out a questionnaire, they build a portfolio.
Pretty much. Based on your answers about your risk profile and investment goals, they aim to provide appropriate asset allocation automatically. However, the sources do note a potential limitation.
What's that?
Some robo-advisors might limit themselves to a relatively small selection of underlying funds, perhaps around 10 ETFs or so.
Only 10?
Well, those 10 ETFs might cover broad asset classes, U.S. stocks, international stocks, bonds, etc. But it still means the investor is getting whatever level of diversification is within those specific 10 funds. There might still be room for diversification or suboptimal diversification at a more granular level within those broad categories.
So it provides diversification at high level, maybe simplifies things, but maybe doesn't achieve that really fine-tuned, potentially higher number of holdings the research suggests could be optimal.
It might not get you to that 280 stock equivalent level of granularity, yes. It's a trade-off between simplicity, cost, and potentially optimal diversification.
Okay. What about simpler, widely available guidance, like those pie charts you always see?
Yes, traditional suggested asset allocations are ubiquitous. These are the models that recommend, say, 60% in stocks and 40% in bonds for a moderate investor, or 80-20 for an aggressive one, often adjusting based on age or time horizon.
The standard advice.
And there are excellent starting points for broad asset allocation.
Yeah.
They are based on historical risk and return data for asset classes. However, as the sources implicitly point out, they don't solve the diversification problem within those asset classes.
Right. That sector risk problem again.
Exactly. You might be 60% in stocks, according to the model. But if those stocks are poorly chosen or too concentrated in certain sectors or styles, you could still be diversified within that 60% stock allocation.
So these models give you the big picture, but you still need to be smart about the details within each slice of the pie.
Precisely. And that's why, for many investors, using managed funds like mutual funds or ETFs as core holdings is a really practical way to get built-in diversification.
Let the fund manager handle the details.
Essentially, yes. Funds like target date retirement funds, which automatically adjust their stock-bond mix as you get closer to retirement, are designed for this. Or lifestyle funds, like Vanguard's Life Strategy funds mentioned in the sources, which maintain a fixed allocation. These are professionally managed portfolios designed explicitly to provide diversification across hundreds or even thousands of underlying securities.
So the manager is worrying about getting closer to that optimal number.
They're handling the selection and weighting, aiming for a specific risk profile consistent with the fund's objective. This takes the burden of security-level diversification off the individual investor and is a primary way to avoid diversification within that portion of your portfolio. You're buying a pre-diversified package.
It sounds like the core message across these solutions is either lean on technology or professionals who can perform the complex analysis, or use pre-packaged solutions like diversified funds that do it for you. Is there one final piece of advice from the sources on adding individual investments if you do decide to pick your own stocks or add something specific?
Yes, a very important piece of advice, often overlooked by individuals, is to watch closely the correlation of new investments.
Correlation again. Back to MPT basics.
Exactly. When you're thinking about adding a new stock or a new fund, don't just look at its potential individual return or how exciting it seems. Think about how its returns are likely to move in relation to everything else you already own.
How it fits the puzzle.
Precisely. Adding a stock that tends to go up and down exactly like your other stocks doesn't add much diversification benefit, even if it seems like a good company on its own. The real power of diversification, rooted in MPT, comes from adding assets that have low correlation, or ideally even negative correlation assets that tend to move in different directions, or at least not in lockstep.
Zig when others zag.
That's the idea. Adding a highly correlated asset is a quick way to add complexity without adding much real risk reduction, potentially pushing you towards diversification territory faster.
So it's about how the new piece fits into the overall portfolio puzzle, not just whether it's a shiny piece on its own.
Yeah.
Okay, makes sense. How does this study, with its finding of 285 optimal stocks for mutual funds, directly speak to our listener who might have, say, a portfolio of 30 individual stocks they manage themselves? Is that number relevant?
That's where you connect the dots. While the study focused on professional mutual funds and specifically Class A shares, which often have higher minimums and are associated with larger long-term investments.
So maybe not the average DIY investor.
Maybe not directly comparable in terms of scale, but the underlying concept is universally applicable. It tells us that diversification benefits are real and potentially extend to a relatively high number of holdings before diminishing returns really bite hard.
So for an individual with 30 stocks,
this research strongly suggests they are likely still in the zone, where adding more holdings, if done thoughtfully with an eye on diversification and correlation, could further improve their risk-adjusted returns. They're likely on the steep left-hand side of that quadratic curve we talked about, where diversification is still yielding significant benefits.
they probably haven't hit the peak yet.
Very likely not, according to this research framework. The study provides a kind of professional benchmark or perspective. It shows that even the pros managing huge funds find that optimal diversification, at least during this period, required a significant number of holdings, far more than the average individual investor might typically hold.
So it encourages you to think critically.
Exactly. It encourages critical thinking about your own portfolio. Are you diversified enough to significantly reduce idiosyncratic risk? Or are you perhaps adding holdings haphazardly without thinking about how they truly add to your portfolio's diversification, potentially just adding complexity and cost without much benefit?
It provides a benchmark to make you pause and evaluate your own strategy, no matter the size of your portfolio. Helps you question if your 20, 30, 50 stocks are really doing the job effectively.
Exactly. The study itself states its aim is to enhance market efficiency by giving this crucial information not just to fund managers, but also, importantly, to wealthy retail investors with long-term strategies. Because the principles apply to anyone seriously focused on building a robust, long-term portfolio that balances risk and return effectively.
And of course, like any academic research, this study has its limitations that are important to keep in mind, right? We shouldn't take 285 as gospel.
Absolutely not. And the researchers are upfront about this. First, the studies are based on historical data from 2016 to 2023. Past performance is never a guarantee of future results, and market conditions are always evolving. The optimal number they found is specific to that time frame and those market dynamics. It could be different now or next year.
Okay, what else?
Secondly, financial crises, as we discussed, are unique events. The COVID-19 pandemic was a specific type of shock. The impact on optimal diversification might be different in future crises, triggered by different factors, say, a pure financial crisis versus a health crisis.
Fair point.
Thirdly, the study relies heavily on the Sharpe ratio as the measure of risk-adjusted return. It's standard, but it does assume that asset returns follow a somewhat normal bell curve distribution. In reality, especially during crises, returns can be far from normally distributed. They could exhibit fat tails or extreme events.
Black swans.
Right, which the Sharpe ratio might not fully capture the risk of.
Right.
And finally, remember the study focused on professionally managed U.S. equity mutual funds. While the concepts are broadly applicable, the specific quantitative results, the exact optimal number might differ for an independent retail investor who has different trading costs, maybe different access to information, or perhaps behaves differently than a fund manager under pressure.
All good caveats to remember. Okay, let's try and sum this up. So the core takeaway from this deep dive into our listener sources seems pretty powerful. While diversification is absolutely essential for managing risk, it's not a process of endless improvement. There is a point of diversification where adding more investments actually begins to diminish your portfolio's risk-adjusted return.
Due to complexity, costs, and the dilution of performance from your best holdings.
Right. And recent research focusing on U.S. equity mutual funds from 2016-2023 suggests that this optimal level for maximizing risk-adjusted return, measured by the Sharpe ratio, was somewhere around 265 to 285 stocks.
A number significantly higher than what the average fund actually holds, suggesting many professionals might still have had room to improve their diversification according to this metric during that time.
And perhaps most fascinatingly, the unprecedented volatility of the COVID-19 pandemic actually shifted this optimal point higher, requiring more holdings for optimal diversification during that chaotic period compared to calmer times.
Which really shows this isn't just academic, it shows that even professional managers are grappling with this balance, and that the optimal strategy isn't static, but needs to adapt to the market environment.
It really underscores that effective portfolio construction is a thoughtful, ongoing process. It's not just about collecting the most assets, right?
Not at all. It's about building a cohesive structure where each piece serves a purpose in managing risk and pursuing return efficiently. Quality over just quantity.
Okay, so final thought for everyone listening. In a world flooded with investment apps, hot stock tips, endless options, maybe too many choices, is the greatest risk for many investors not having too few investments, but ending up with a portfolio that's so vast, so scattered, and so unfocused that it actually dilutes your potential returns, becomes impossible to manage effectively, racks up unnecessary costs, and leaves you simply tracking the middle, or potentially even falling behind. How do you find your balance between the urge to spread risk wide, maybe feeling safer with more names, and the need for clarity, focus, and efficiency in your own investment journey?
A really important question to ask yourself.
It gives you a lot to think about the next time you consider adding something new to your basket.